This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Yeah, Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Hayden Beamish, thanks very much for coming on Talk Your Book. I thought maybe we could start by you telling us a little bit about Endeavour Asset Management and what you guys look to invest in.
Yeah, no problem, Chris. My pleasure. Thanks for having me. So, Endeavour, we're a relatively small fund based in Albert Park in Melbourne. We've got about $300 million under management. We have a small amount of holdings, between 20 and 30 holdings, and we're just looking for great businesses where we can invest alongside management we trust, with good operating metrics, good balance sheets, high return on capital, good organic growth prospects. So a lot of the time we invest on the ASX, but we find ourselves investing in offshore businesses just because we like that large addressable market that companies can grow into, and ideally not too leveraged to the swings of the economy, and can grow on their own merits.
And what stock do you want to talk about today?
So today I'm going to talk about Altium, which in my opinion is one of the best software companies to come out of Australia. So it was actually founded in Tasmania in the 80s as a university project. They recruited the CEO from the maths division in about mid 80s, and it's gone from zero to 250 million revenue and 100 million EBITDA and 40% margin. They're now based in San Diego with 500 staff. They've got offices worldwide. I've got a good customer list with sort of Tesla, Microsoft, Audi, Cochlear, Boeing, and it's a great Australian success story. So in my opinion, it's still got some good upside here. I can explain a bit more about what they do, but they're a large player in PCB design, which is essentially in the electronics industry, and PCB is a printed circuit board, but they're still tiny in the whole ecosystem they operate in.
So talk me through about the PCB market. What's the size of that market and the overall addressable market that Altium playing?
So the total addressable market at the moment with just the printed circuit board design, and maybe it's just worth talking about that a little bit. So the PCB powers every electronic device. So obvious tailwinds there with sort of electronic device sales, 5G, Internet of Things, even, your fridge is connected to the internet these days, and even electric vehicles and cars, they're all becoming software now. So they've got a huge tailwind just with the electronics industry. And there's a theory which you probably know, and your listeners would as well, Moore's Law, which is that speed doubles and costs halve every 2 years. And interestingly, that theory was based on semiconductors, and it's now slowing down, the theory. So there's more reliance on the printed circuit board design. So with the Altium software, we're just talking about the board that you will pull the software up, expand it on your screen, and you choose your design where you want to put the GPS chip, the Wi-Fi, the wires between it. And there's a fair amount of design there, but just based on the electronic device it's going into. So yeah, they're well positioned to ride the growth in the PCB industry, and also take market share from competitors, which they've been doing over the past 10 years.
And what are their other business units?
They've got a few. They've got two small ones, say Nexus and Tasking, which they're small but important divisions. Like Nexus is used for high-end enterprise customers, and Tasking is used for software design for cars and autonomous vehicles. And then they've got three divisions which they're joining together in Altium 365. So one of them's Octopart, which the best way to think of it is Google for parts. It sort of aggregates a library of all the parts used in electrical design, and they take a clip of the sales, and they also sell banner ads on the website, and you can pay for a higher ranking on the site. So it's Google for parts, and it's small, but they've doubled their revenue from 12 mil 2 years ago to 25 now. So that's growing strongly. And they've got a software for the manufacturer. So you think the designer designs the board, he sends it to the manufacturer, they make it. Manufacturing is a very low margin, sort of capital intensive industry, but they've got a software to track their components. And then the third part is Altium Designer, which is the core software. So they just announced Altium 365 over recent years, and that pulls all three parts together. You can work remotely on any device. You can allow others access through an online reader and sort of communicate on projects together. And that's driving a lot of the growth at the moment. And it sort of leads into their long-term plan, which is to become the go-to platform for the industry, which is a massive market, if they can be the platform of choice.
So talk to me about the size of that market, if they become the platform of choice for the industry, and what percentage of that market you think they can get?
Yeah, it's a good question, and it's a big driver of the valuation because your small assumptions make such a big impact. But the current market they're in just for design is about a 680 mil addressable market, and they're reaching they're tracking towards their goal is 50% market share, and once you join the platform together with designer, parts, Octopart, have the manufacturer involved on the platform, the addressable market goes up to about $2 trillion. So we're not assuming they will capture a significant portion of this market if they do pull off the long-term plan. But say if there was a $2 trillion industry and they have 50% of the designers on the platform, you attract the manufacturers because the designers pay for the manufacturers. The manufacturers want to be on the platform to get the work from the designers. So if they were to get 10% of the 2 trillion market, that's $200 billion, and they're hoping for a 5% clip through the platform. So you could see them having $10 billion revenue, and this is if they pull this off, and you model the business out, and a 50% free cash flow margin is feasible. So $5 billion of free cash flow, and it's trading on 40 times free cash flow at the moment. But say if that multiple halves from 40 to 20 times, it's $100 billion valuation. Current market cap of 4 billion Aussie, so 3 bill US. So maybe the market's ascribing a 3% chance of them being successful in the grand plan, which is probably fair.
Talk to me, is their historical financial performance has just looked, a thing of beauty for stock investors. Maybe talk about their compound annual growth rate and their return on equity and some of the metrics they have, which would be appealing to a lot of investors.
Yeah, they have been, and that's why, it's been a great high quality business, and that's why they've commanded the multiple that they trade on. And I think the main one for us, we found out him 2015. I think it was around $5, and it was actually from an EBIT margin increase screen that we run for companies. So Australia and US, we pull in the live consensus forecast, and I think these days if you've got a margin above 10-15%, there's probably a well-funded startup somewhere coming for you. And if you're increasing your margin over time, I think it shows you've just got real IP, and we're tracking Altium, and the margin every half EBIT margin was steadily increasing. So that sort of attracted us to the business, had a high return on capital. The revenue growth was strong. The earnings growth was quicker than the revenue growth. And that's just an attribute of software companies that have that high initial fixed cost. And then once you've depreciated the assets, or you've worked through the initial upfront investment, the high proportion of the revenue drops to the bottom line. So it's sort of on the surface, all the financials were very attractive. And here it was growing its EBIT at 40% up until last half. And since then they've had a few downgrades, but I think that's now is the opportunity, because it's been a tougher period in the stock, and they've offered some payment terms, and the market's concerned about that, but I think it does build customer loyalty. And if you could sort of look through this soft period, you are getting a great company on a fair value. So trading 40 times free cash flow at the moment, but just if they hit their targets of doubling users from 50,000 to 100,000 by FY25, and that's management's expectation. If they can hit those goals, we can still get 100% upside on the DCF from here.
Yeah, so they've dropped their prices for some of their products, which you alluded to there. Talk us through that, and how long do you think it'll be before they can start to get those margins back that they've lost through that?
Yeah, so they have dropped their prices just through, March, April, and they've got two components to their sales business. So they've got a perpetual license, which is best way to think of it is like the old Office, say 2015, and Altium Design is just akin to Office for the finance industry. If you want to go into the PCB industry, you want Designer on your resume, and it's just the go-to software. So it is comparable, and Designer is obviously a lot more expensive, but their one-off license is about $7,000 to $8,000 US, and then they've got the Office 365 cloud equivalent, which is about $2,000 per year. So in the last 3 months, the part of their revenue growth is from converting the old license to this new annual subscription. And you can see why tech companies over the past, if someone, past 3 months, someone's coming to you to try and upgrade, you're speaking to your manager, I think we could upgrade to 2,000 a year. Management would just say, we don't even know what our budget looks like for this year or next. Let's hold off and stick with the product that is working okay. So they had this soft period. They slowed down their payment terms, and they also brought out an installment plan. So it was probably the first sign that revenue was tracking a bit softer. And I think this just all builds customer loyalty in the end.
So many of these tech stocks have an inverse correlation to bond yields or a strong correlation to bond prices. This appears like it'll be similar. Do you ever get a feeling with these sorts of business that it's just another way to articulate that same trade of low bond yields, central bank currency printing, and really high valuations for stocks that can demonstrate a reasonable growth profile?
It's a huge factor. We've had, as we were saying before, we've had rates, since the 1980s have come from 15% down to 0.75%. Well, this is a 10-year bond yield, which sort of reflects future rate expectations. And in January, we had the bond yield was 1.75, and I remember thinking that the markets had a good rally, and the risk now is that inflation is going to come through, and we're going to have bond yields increase. So this is going to really impact growth valuations, because it is a big factor. Like we've had just the last decade, the yield's gone from 5 to 0.75. So the discount rate that we use has come from 11% to 7%. So if you're a high growth company and you've got your value in later years and you discount that back at a lower rate, it has a huge implication for valuations. And now we've had, since the coronavirus, central bank easing around the world, the 10-year yield's around 0.7. So that has a big impact, and that's why we've seen the rally we have over the past 3 months, especially in the US. And if that rate was to increase, that's a factor we would look at, because we don't try and predict it, but we will use it as a current input. And if rates are going up, there'll be a bit of a rotation away from growth back into inflation-producing assets that are a bit cheaper.
More broadly on that, could you see a world where inflation does pick up, but central banks implement yield curve control on bond yields around the world? And in that environment, would that be the best possible scenario for this, where they can get some pricing inflation, but the valuation metrics still remain incredibly high?
Yeah, that's right. So fingers crossed that plays out, and I think that's a logical expectation, considering the debt globally, that the only way out now is to inflate their way out of it. And if rates increase, they wouldn't be able to increase too much without having a bit of an impact on economic growth. So I think that is likely, and that's that is the ideal scenario for these high quality growth businesses.
And lastly, investors love sort of small narratives to make complex idea around investing simpler. You often hear with gold miners and people that make money in a gold rush are those that sold the picks and the shovels. That IoT thematic, which has been huge, but to play it through pure play IoT companies often been really hard. Do you see that as a bit of this is almost a play on that, whereby you can buy the picks and shovels to such a big thematic without maybe the margin compression that some of those IoT providers are going to cop?
It's an interesting way to think about it, because they are leveraged to the thematic, and the industry is growing strongly. And and they've had this recent hiccup where the market's sort of looking through their new payment plans, and we've looked at, you know, a few channel checks in the industry that suggest the industry is actually okay. We spoke to a contact at a PCB design firm, and he's very busy, and they're one of their competitors, Mentor, has been purchased by Siemens, and they now focus on wire design for cables in planes and cars, because that's Siemens' main business. And you look at Octopart, which, you know, they own the parts business. They had semiconductor sales went up 6% in May, and that's a bit of a leading indicator for their demand, because you buy the semiconductor to put on the PCB board first. So there are some good signs there for the industry, and there aren't many ways to play it in Australia, especially the Internet of Things thematic, general electronics. We can't buy Apple, Samsung, or it's hard to get close to management from Australia. So it's a good way to play it, especially with a high quality business that they've proven themselves over the last 25 years.
And we know Altium made an acquisition not so long ago. Do you think there's any chance Altium could be a takeover target in the next 2 to 3 years?
I would have said yes when we first invested, and that was around, you know, the share price was a lot lower, and they had a partnership with Dassault, which is a French business that it sort of made sense to acquire Altium and keep the margin to themselves. But now at the $4 billion market cap, and they're the leader in the industry, so there's no incumbent that would take them over to protect their high market share. So I sort of think the opportunity is there for Altium's for the taking, and they're the only one really with this grand plan to consolidate the industry together with the manufacturing as well. No one's really thinking with that amount of vision. That is sort of a 10 to 15 year plan. So I would doubt it at this price, and especially the multiple it trades on, because, you know, it'd be hard to get some synergies by taking it over. You'd really have to buy into this 5 to 10 year plan to see some upside, but that's what we're doing, and we're confident they'll deliver.
Beautiful, mate. Well, it's a compelling story. You've articulated it really well. So thanks very much for coming on the show.
My pleasure.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talk Your Book. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.